Hold on to your pith helmets, folks, because we're diving deep into the Malaysian jungle with a story about trees, taxes, and a whole lot of cash. It's the case of Mamor Sendirian Berhad v Director General of Inland Revenue. And if you're thinking, that sounds as thrilling as watching paint dry, just you wait. This case went all the way to the Privy Council, which, for you non-Commonwealth folks, is like the Supreme Court, but with fancier wigs. So, what's the big deal? Well, it all boils down to this. When a company chops down trees to make way for a palm oil plantation, is the money they make from selling that timber just a happy little bonus, or is it a whole separate business venture? The answer, as you might have guessed, is about as clear as mud. But hey, that's what makes this case so juicy. It's all about interpretation, legal loopholes, and whether you can convince a bunch of judges in wigs that your intentions were pure. Buckle up, because things are about to get wild. We're talking about serious money here, folks, the kind that could make even a lumberjack blush. And the Malaysian government, well, they wanted their cut. Mamor, on the other hand, argued that the timber money was just a lucky break, a little something to help them clear the land for their real moneymaker palm oil. So, who's right? Grab your gavel, because we're about to find out. Imagine this. You've got a big backyard, overgrown and full of trees. You decide to turn it into a beautiful garden, but first, you need to clear the land. Now, you could just pay someone to haul those trees away, but what if you could sell them for lumber? That'd be pretty sweet, right? That's essentially what Mamor Sendirian Berhad did. They had this massive plot of land in Malaysia, and they wanted to turn it into a lucrative palm oil plantation. But first, they had to deal with all those pesky trees. So they did what any savvy business would do. They sold the timber. And let me tell you, those trees were worth a pretty penny. Now here's where things get tricky. The Malaysian government, being the tax-hungry entity it is, saw this timber money and thought, hold on a minute, that looks like income to us. Mamor, however, argued that it was all part of their grand plan to cultivate palm oil, a long-term investment, not some get-rich-quick scheme. They claimed the timber sales were merely incidental to their main business of palm oil production. It's a classic case of, is it a duck or a rabbit? Depending on how you look at it, Mamor was either running two separate businesses, timber and palm oil, or just one big complicated operation. And the answer to that question had huge implications for how much tax they'd have to cough up. Let's rewind a bit and talk about Mamor's grand plan. See, back in the day, they snagged a sweet deal with the Johor state government, a lease for a massive chunk of land. We're talking thousands of acres, folks, ripe for the picking, or in this case, the planting. The goal? To transform this untouched wilderness into a thriving palm oil plantation. Sounds simple enough, right? Well, not so fast. Remember those pesky trees? Turns out they were more than just an obstacle. They were a gold mine. See, Malaysia's got some seriously valuable timber, and Mamor knew it. So they struck a deal with a logging company. This company would come in, clear the land, and pay Mamor a handsome sum for the privilege of hauling away all that precious timber. Now you might be thinking, why didn't Mamor just keep the timber money and call it a day? Well, for one, palm oil is big business in Malaysia. We're talking cooking oil, cosmetics, biofuel, you name it, palm oil's in it. Mamor was playing the long game, aiming for those sweet, sweet palm oil profits that would keep on flowing for years to come. But here's the kicker. The taxman doesn't really care about your long-term goals or your love for sustainable agriculture. They care about one thing and one thing only, cold, hard cash. And when they saw all that timber money rolling in, they started licking their chops. Section 4, the courts weigh in a game of legal ping-pong. This is where things get really interesting. The case of Mamor Sendirian Berhad versus Director General of Inland Revenue bounced around the Malaysian legal system like a ping-pong ball on Red Bull. It went from the Special Commissioners, think Tax Court, to the High Court, then up to the Federal Court, and finally all the way across the pond to the Privy Council in London. Talk about a legal odyssey. At each stage, the big question remained the same. Were those timber sales just a byproduct of Mamor's palm oil dreams, or were they a separate business venture altogether? The Special Commissioners, bless their hearts, sided with Mamor. They bought the whole incidental to palm oil argument, much to the chagrin of the taxman. But the government, stubborn as a mule, wasn't about to give up that easily. They appealed to the High Court, and guess what? The High Court agreed with them. They ruled that nope, those timber sales were a separate business, meaning Mamor owed a hefty chunk of change in taxes. Mamor, understandably, wasn't too thrilled about this turn of events. So they appealed again, this time to the federal court, Malaysia's highest court. And guess what? The federal court sided with Mamor. The legal ping-pong match continued, and with each volley, the stakes got higher. It was a classic David versus Goliath battle, with Mamor, the plucky underdog, facing off against the mighty Malaysian government and its bottomless pit of legal resources. Section 5. The Privy Council's verdict: timber money isn't free money. After years of legal wrangling, the case finally landed on the desks of the Privy Council, the highest court of appeal for many Commonwealth countries. These judges, with their fancy robes and even fancier accents, had the final say in the matter. And their verdict? Well, it wasn't exactly music to Mamor's ears. The Privy Council ruled in favour of the Malaysian government, declaring that the timber sales were indeed a separate business activity and therefore subject to income tax. They argued that Mamor had entered into a deliberate and calculated agreement with the logging company, knowing full well they'd be raking in a substantial profit from the timber alone. Essentially, the Privy Council saw through Mamor's incidental claims and recognised that the company was essentially wearing two hats, one as a timber merchant and another as a palm oil plantation developer. And just because they planned to use the timber profits to fund their palm oil venture, didn't make those profits any less taxable. Section 6. Taxman's Take. When profits are more than just a seed. This wasn't just a victory for the Malaysian taxman, it was a resounding affirmation of a fundamental principle of taxation. You can't just slap a different label on your profits and expect the taxman to look the other way. The Privy Council's decision sent a clear message. If you're generating income from a distinct activity, even if it's related to your main business, you'd better be prepared to pay your fair share. The case of Mamor Sendirian Berhad versus Director General of Inland Revenue highlighted the importance of distinguishing between income and capital receipts. Income, as the taxman will tell you, is money earned from your regular business activities like selling goods or providing services. Capital receipts, on the other hand, are generally one-off gains from selling assets, like land or buildings. Mamor tried to argue that the timber sales were capital receipts, a one-time windfall from selling off part of their land. But the Privy Council saw through this argument, recognizing that Mamor had actively engaged in a profit-making venture by selling the timber. It wasn't just a matter of clearing land, it was a calculated business decision that generated significant income. Section 7. Lessons learned. Keeping your business on the right side of the taxman. The Mamor case serves as a cautionary tale for businesses worldwide. It highlights the importance of carefully considering the tax implications of all your business activities, even those that seem incidental or secondary to your main operations. What might seem like a clever way to minimize your tax liability could come back to bite you if you're not careful. Here's the takeaway, folks. When it comes to taxes, transparency is key. Trying to pull the wool over the taxman's eyes is rarely a good idea. If you're engaged in multiple business activities, make sure you're accounting for them separately and paying the appropriate taxes. It's always a good idea to seek professional advice from tax experts who can help you navigate the often complex world of taxation. They can help you structure your business operations in a tax-efficient manner while ensuring you're on the right side of the law. Remember, folks, paying your taxes might not be the most exciting thing in the world, but it's a small price to pay for living in a functioning society. And besides, do you really want to mess with the tax man? Those guys have seen it all, and they've got ways of making your life difficult.